Okay, let's jump right into this explainer and unpack the massive wall of financial data surrounding SkyWest, because we really need to see what the numbers are actually telling us here. If you've been following the regional airline space at all, you already know it can be an incredibly turbulent sector to analyze. But today, we're cutting straight through all that market noise to focus entirely on the hard metrics. We're going to build a comprehensive picture of SkyWest's financial health, layer by layer, and use the data to solve what I'm calling a true valuation mystery. Now, what's really wild right off the bat is this massive margin of safety. Sitting at over 60%, this number immediately raises a huge red, or maybe green, flag about how the market is currently viewing the stock. In financial analysis, a margin of safety this incredibly high usually implies one of two things. Either the market is pricing in some catastrophic future event, or the stock is genuinely deeply undervalued compared to the actual cash it produces. And this perfectly illustrates the core mystery we're exploring today. We have the reality of the open market, right? A stock currently trading at roughly $81. But when we calculate the intrinsic value using discounted cash flow metrics, the fair value price comes out to just over $205. Wow, that is an absolute chasm between what the market says the company is worth today and what the cash flows suggest it should actually be worth. So to figure out why this massive gap exists, we absolutely have to look under the hood at how the market is pricing SkyWest relative to its earnings and its assets. I mean, we can't just take a fair value calculation at face value. We've got to cross-reference it with how investors are actually trading the shares on a multiple basis right now. Looking at these core valuation multiples, the discount becomes even more apparent. The current price-to-earnings ratio is sitting at a remarkably low 7.79. That's actually a 21% discount compared to its own trailing 12-month average. On top of that, the price-to-sales at 0.78 and price-to-book at 1.18 are also trading at significant double-digit discounts to their recent historical averages. Across the board, traditional value metrics are flashing bright green. But wait, the crucial point here is understanding the PEG ratio. Looking at PE alone just isn't enough. Because, let's be honest, a low PE could just mean a company is dying. The PEG ratio factors in earnings growth to give us a much clearer picture of whether a low multiple means the stock is actually a bargain, or if it's just a struggling business that deserves a cheap price tag. And here is where the data gets genuinely fascinating. SkyWest's PEG ratio sits at a remarkably low 0.40. Remember, anything under 1.0 is generally considered undervalued. However, context is everything. Even though 0.40 is incredibly cheap, that number is actually up over 115% compared to its 3-year average. So while it's cheap today, it's significantly less cheap relative to growth than it has been in the recent past. Let's see how this valuation builds into the historical performance to understand how this stock has actually behaved over the last few years. Because if the valuation metrics look this good, we really have to ask why investors might be so hesitant. And usually the answer lies in the stock's recent behavioral history, which, in this case, has been anything but smooth. This data reveals a history of incredible, absolute stomach-churning volatility. We see crushing drops, notably a 37% loss in 2020 and a massive 57% wipeout in 2022. But then, look at the whiplash. Explosive triple-digit gains of over 216% in 2023, followed by another near double in 2024. This is a stock that makes massive swings, heavily influenced by macro airline economics. When we smooth those wild yearly swings out into compound annual growth rates, a distinct pattern emerges. We see a remarkably strong 41% average over the 3-year timeline, driven entirely by that massive 2023 recovery. But looking at the trailing 12 months, a concerning 8% drop stands out. The powerful momentum of the last 2 years has suddenly, violently hit a wall. And this recent slump is heavily reflected in the year-to-date return. The stock is currently down over 19% for the year. This negative short-term momentum is the exact friction we're feeling right now. It's exactly why those valuation multiples we looked at earlier are contracting. The market is actively selling the stock down right now, creating that massive discount to fair value. With the stock price dropping recently, despite those tantalizingly low valuation metrics, we've got to investigate the company's actual operational health. We need to detach from the stock ticker for a moment and look directly at the business engine itself. Are they actually making money? And more importantly, are they using that money wisely? To answer that, I always love checking ROIC, or return on invested capital. This is a phenomenal metric because it tells us entirely objectively how well management is using the cash and debt they have on hand to generate actual, tangible returns. It strips away all the accounting magic and shows us the raw efficiency of the business operations. Right now, SkyWest's current ROIC sits at 8.06%. But what you really need to take away from this is the trajectory. That 8% figure represents a massive improvement, sitting more than 62% higher than its 3-year average. Management is demonstrably getting better at generating a return on the capital they're deploying into the business. Furthermore, when we look at the pure bottom line, the net income growth is undeniably strong. The company boasts an impressive 18% net income growth over the trailing 12 months. And when you pull the lens back, you see staggering triple-digit growth over the 3- and 5-year horizons. From a pure profitability standpoint, this engine is absolutely roaring. However, as we dig deeper, the data isn't entirely perfect. While the 3-year average free cash flow growth was a phenomenal 106%, the trailing 12 months show a very sharp 31% decline. This is a critical turning point in the data. Net income is great, but cash is king. A sharp drop in free cash flow generation over the last year is very likely the exact reason for the market's recent hesitation and that 19% year-to-date drop we saw earlier. But here is the silver lining to that cash flow dip. The balance sheet remains relatively conservative. The debt-to-equity ratio stands at just 0.88. Even better, that debt load is actually down by over 25% compared to its 3-year average. So while free cash flow has tightened recently, the company is not overly burdened by debt, which gives them a really sturdy foundation to weather any short-term turbulence. Okay, let's step back and compile all of these fascinating data points. We've looked at the valuation gap, the historical whiplash, and the operational engine. To figure out what you should actually take away from this explainer, we need to balance the scales. On the bullish side of the ledger, the data paints an incredibly compelling picture. We've got a highly profitable company, growing its net income and improving its capital efficiency, all while carrying a manageable and decreasing debt load. And best of all, you can currently buy this business at an incredibly steep discount, with a PE under 8 and a massive 60% margin of safety relative to its estimated intrinsic value of $205. Conversely, the bearish data points are literally impossible to ignore. This stock subjects investors to extreme historical price swings. Right now, it's caught in heavily negative short-term momentum, dropping 19% this year alone. And operationally, that concerning 31% drop in recent free cash flow generation gives bears a very valid reason to argue that the business might be facing incoming headwinds that the net income hasn't fully reflected yet. Ultimately, the numbers leave us with this provocative question. Is this massive gap between the $81 market price and the $205 intrinsic value the ultimate buying opportunity, or is it just a classic value trap? The data proves one thing definitively. Relying purely on fair value metrics is fascinating, but capitalizing on them, well, that requires a very strong stomach for extreme volatility. Thanks for diving into the numbers with me today.